Hi, are you able to see my screen? Great. Thanks for joining in, Rajiv, Yash, Akshat, Naresh, Samrat, hi. Great, so we are 1 minute past 6:30. I think it's great to start. Hi, Nikhil. So good you're able to see the screen. So I'll start off by thanking you all for joining me today. I know it's a Thursday and good that you could take some time out. This is a part of my series where I give you a lot of ideas, especially how to be psychologically fit to become a better investor. I'm sure over a period of time, when you look at, when you go to any of these social media channels, there are a lot of places where you can find out which is the next best stock to buy, best mutual fund to buy, so on and so forth. But I feel there's a clear lack of people talking about the right mindset that one needs to have to become wealthy. And that has been my endeavor right from start. And I hope at the end of this session, you go off as a slightly better investor than you were at 6:30 p.m. today. Let me start by telling you a story. On Saturday last week, I was watching a football match with my friend and my brother, and interestingly, there was a penalty kick awarded. And then we all started talking about how or which way should the goalkeeper actually go. Should he go left or right? I'm sorry, I'm facing a little bit of a trouble. Yeah. Should go once again. Great. So again, I'll go back to the story bit. So on Saturday, a couple of weeks back, both my friend, my brother, we were all watching a football match, and there was a penalty kick awarded, and we all started discussing on which way should the goalkeeper move. Should it be left or right? Or primarily they were discussing only left or right, and nobody said we should, or he can also stand just straight. Incidentally, I told them that there are good chances that by standing in the center, 28% of the times he could save the goal. To which one of them said, no, we need to show action, otherwise it look ugly. Just imagine you going, standing straight in the middle, and on the left and the right, like the ball goes, you will look very dirty and ugly. So he has to show some action. To which I didn't have an answer at that point in time, but let me show you what happened after that, right? So here is a chart of the World Cup penalty hits. If you see, it is evenly spread between left and right, but it is not that the goalkeeper couldn't have scored if he was right in the center. I'll tell you why I'm going to this, but first let's see what happened to the penalty kick.
Chance for Ronaldo to start his 9th century of goals. Never in doubt. 800 becomes 801 in the blink of an eye. Manchester United's advantage restored in this topsy-turvy, crazy encounter.
By now, I'm sure you'd all known that I'm a big Manchester United fan, and I'm of course a bigger fan of Ronaldo, and I'm very happy that he's there. Coming to the point, if you see, he hit straight, and then there was a pin drop silence that followed after he hit straight and scored for Manchester United against Arsenal. Now, why am I linking this? Where am I getting you to? The point is, we as investors or traders, we want to show a lot of action all the time. Again, I want to emphasize on the word action and show. It doesn't necessarily need to be there, but as an investor, our mind plays a lot of games saying, you should sell now, buy later, if it falls. If it doesn't fall, wait for averages and this and that. And mind confuses you quite a bit when you are in a position to, or you've made some money on the position that you have created. But then this sell high, buy low is a great strategy, no doubt about that. Fundamentally, it's a good strategy, and if you could do it, nothing like it. But the problem is execution is never perfect. Let's say you did sell and the share price came down by 10%. Do you think you will buy at that point in time? No. Your mind will then start saying it can go another 15%. Then it will say it can go another 5%, 10%. And your mind keeps on saying that the price will keep going lower. And at some point in time, the price starts going up. Now, do you think you'll be able to buy it? No, primarily because your mind has seen or you have seen a lower price. So it is very difficult for you to buy at higher price. And this way you will end up losing the entire rally that starts after the stock has gone down by 10, 15% or so. You would see it every time. I can go back to April 20 example or May 20 example, forget all that. Just see the recent example of November, December 2021. Some news came in, share prices fell off, but you were never in a position to buy it back because, or if you had sold, you're never in a position to buy it back just to see that the prices are higher at this point in time. You need to understand that sell high and buy low, it may not be a sustainable strategy too, primarily because markets are generally irrational. Let's say you sold at an X price, it doesn't mean that the market will correct from there. It can actually go on to become higher and higher and higher. So markets are far more irrational in the short term, longer than you expect. And finally, the most important thing which we all don't focus on at all is psychologically, you need a very, very strong mindset to do selling high and buying low at all given point in time, which I think not many people really have. And if you really had, you would actually rather allow the profits to run. Therefore, I strongly believe that timing, people say, I know how to time the market. I'm yet to figure out someone who has timed the market correct twice, right? So people think timing is easy. I don't think one bit that timing is a great strategy at all. Let's say you want to cure your irrational behavior, investing behavior. What are the cures? I have 4 cures. The cure number 1, in your mind, just do this. Replace a stock performance with business performance. What I mean here is nothing but stop watching share price movement of the company that you're invested in. Listen, you're not investing in companies. You're not investing in companies for share price increase. You're investing after analyzing a fund or a company because you expect that the company's earnings will go up. The company's market share will go up, leading to earnings per share increase. And when the earnings per share increases, the share prices automatically increase. It is as simple as that. The day you start watching business performance and not watching the share price performance, you will stop worrying about the market fall and the market rise. You know that sometimes irrationally that stock would have fallen for no reason. At that point in time, you would be brave enough to go and buy. And you also know when the stock prices go up for no reason or come down for particularly the performance reason, and that is when you become a little more cautious. So first cure for you to do is replace the stock performance with business performance. See how the management, how the particular set of people on the ground are doing and making the change to grow better and faster. Got it? Now on the second one, we do buying and selling for no reason. Just see your own history. Suddenly, one day you decide that, okay, I think markets are high, and you press that sell button, only to realize that the markets end up going 10, 15, 20% higher than those levels. Now, if you had a reason to sell or buy a certain stock or a mutual fund or any other fund, maybe you would have avoided doing those transactions. That's why I said when you start linking the business performance, you would try and understand what is the reason for that particular company to go down. And if it is not related to its own business and general market fall, you will actually go and buy. And on the other side, now you would say, okay, I'm talking only about fall. Why not about gains? Let's say your portfolio gains stupendously, which I wish everybody does. And then one or two of those holdings become very big. Let's say 50, 60, 70% of your holdings. Do you lose sleep over it? If it is so, then follow a simple method of asset allocation. Asset allocation is nothing but forming a framework within which you will make sure that the fund, the stock that you invested in will remain all the time. You can keep rebalancing quarterly, you can keep rebalancing half yearly or at a time frame that you're comfortable with. So asset allocation is a solution if a certain stock or a fund becomes huge part of your portfolio and that is giving you sleepless night. After all, what's the point of becoming rich if you cannot sleep peacefully, right? So follow asset allocation when the share prices go up. This is one framework that you can do, and try and analyze the business performance of the company or the share if it comes down. If you have this framework, maybe you will not sell or buy for no reason. You will purely go by performances. This is our cure number 2. Cure number 3. This is something which is very dear to me. A lot of people today, a lot of my investors ask me, okay, what is your expectation of UP elections? I go and tell them that doesn't matter to me. They said, how will it not matter? Last time when the UP election happened, the market went up by 4% in the opening. I remember that very clearly, of course. But the point I'm trying to say is, will I make a decision basis a prediction or a result that is not in my hand? Let's say what will happen in Punjab, I would not know. Forget everything. Did you know that there will be no repo rate hike yesterday when the RBI governor came? To be honest, the CIOs of large mutual fund houses were expecting a repo rate hike. I have spoken to them personally. So it was a big surprise. So just assume that you thought there will be a repo rate hike and you sold off your position. And then RBI governor comes and does the opposite. The thing that you don't really have a control on. The market shoots up by 250 points, the Nifty actually. So Sensex should be about 800 points, right? So we don't have the potential to control every outcome. We don't know how the economy will fare. All you have an outcome control is on yourself. How will you react to a certain situation? If it falls, how will you react? If it goes up, what will your reaction be? I'm talking about your holdings. So those are the things that you should control. Let's say the market falls. Again, I'm going back to fall because we have been in that fall zone for now. It creates a lot of panic. I've seen it myself when I had gone to meet few people. They were all worried, saying, okay, will this new virus strain lead to a 30% fall? Pretty logical to think about it. But let's say you wanted to buy a certain good company, but then about, let's say, 2 months back, it was very expensive. And today, the same company is cheaper. And you always should have some bit of your portion to invest or a liquid portion to make good these kind of opportunities. So you didn't buy it in, let's say, August, September, and the same share is available cheaper today. So instead of worrying about your current holdings, which are good, just that they're going through a bit of a correction, why don't you use this time and energy to get into those stocks which you actually wanted always to buy, but were not in a position to buy because it was expensive? So you should focus this energy or channelize this energy towards something productive. So use your energy to control things that you can and not on UP, India, global elections. Forget those. You will never be able to do that. And finally, this is very important. Everybody comes and tells you, including me, that compounding is the 8th wonder of the world. You should keep your portfolio on and all forever and stuff like that. But you need to understand that every individual is playing a different game. Just look around you, in your office, in your college, among your family members. One guy is a pure and pure short-term trader. Second guy buys and sells for a 15-20% gain and exits. And the third guy, like you or somebody else, is purely in it for long term. So everyone is playing different games. So what might be suitable for one guy may not really be suitable for the second and the third guy. So don't try to copy others. So if you're someone who believes that I'm in this game to win this first match of the series, that's it. I'm not worried about the entire series. Let's say you win that particular win. Of course, you can actually again go back and win the second game. But you should be content because that the result that you always wanted, you've already got it, correct? So instead of worrying too much about, oh, what if it again, let's say the stock that you sold goes up another 5-10%. If you are in it for a certain price target and if you've achieved it, just exit it. Don't try to copy someone else's game because he may be playing a very different game. So play your own game in this way. You will not be in different, let's say you go in with a different plan and you change your plan. Again, you will go back to the plan, create a lot of confusion, transactions in your portfolio. this may help you avoid those kind of transactions in your portfolio. So this is my cure number 4. Now, just to tell you why timing is not a great strategy, I'll just show you something. So if you see S&P 500 index performance between 1980 till 2020, right, about close to about 40 years, if you had missed or invested all days, okay, your $10,000 would have been at 6.97 times. While even if you had missed the 5 best days because of your timing, just 5 best days, just see the value that you would have ended up with. It's a substantial correction of, substantial loss of about $265,000 on otherwise you would have been at 700,000. Here you will be at $430,000. Just missing those 10 days. Missing the 10 best days and 30 days and 50 days is for you to see. So trying to time and maybe missing a good day is very harmful to your portfolio. Now you can missing a bad day will also be helpful, of course it is, but then how many times are you able to predict the market is another set of question, right? And finally, let's say you're the best timer in the world. You time the market perfectly, okay? Your result would, let's say, between 1993 to 2012, it's a little old data. Even if you're a better or great timer, the difference between investing all your money immediately versus trying to time is not significant enough. It's hardly any difference. If I were to put this on India, a 1 lakh rupee invested in 1998, okay? This one I put it on month basis. We don't have so much data on the daily basis. If you had missed nothing, let's say you just held on to it, that 1 lakh is worth about 12 times today, 11.91 lakhs in Sensex. And let's say you miss 5 best periods, okay? The depreciation or the value that you would miss is about 809 lakh rupees, or 8 lakh rupees is what you will end up missing. So now you decide whether you want to miss those periods or just forget and go through with these ups and downs and be with the market as long as you don't need the money. If that suits your game, play this game. Else, try and modify, create strategies for every sell or every buy. I'm happy to take questions from here. You can put it on the chat box. And I forgot to introduce myself. I've been managing investment portfolios for over 18 years now. I'm an ex-banker, and I formed Augment Capital Services in 2010, and it's been 11 years. It's been a great journey, and I thank all my investors for this. Please feel free to ask me your questions. Hi, Yash. So first question is, is this specific to equity market? See, equity market is where a lot of transaction happens. Debt is a lot more psychologically easy because you just have to buy and the curve keeps looking upward. So you don't have these kind of psychological issues with with debt market. So the presentation was purely to do with equity markets. Naresh, the long-term period depends from or changes from person to person. In general, I am of the belief that if you have a time frame of about 5 to 7 years, you are good to invest in equity. And if you have a very short-term requirement and you don't have the time to keep the money for more than a year or two, then definitely equity is not the place to be. So long-term depends from person to person and the kind of goals that you really have. Like the moment you say 5+ years of goals, I generally suggest equity. Relate to equity. How does this relate to? Abhishek, I didn't understand the question. Equity is always business, right? Because share prices or the company, you invest into a company not because you expect the price of the company shares to go up. You expect the EPS, earnings per share, to go up, which results in company share price. So you're investing in business. Actually, when you invest into a company, you're a shareholder of that business, isn't it? Think of real estate in our portfolio. Real estate, people consider or always compare. I've seen this in the early part of my career. People always used to compare real estate returns, and they always used to say that real estate is the best. This is about 2004 to 2010, 11, 12. But I've shown enough number of times that equity is equally or slightly more better performing than real estate as an investment, especially lands. I don't believe investing for the sake of returns in apartment is a good idea. Samrat, so it is very difficult to crack the right mutual fund to pick up. It is very, very difficult, primarily because you never know what kind of changes the fund manager makes. You never know if the stocks that they would invest will end up being good, bad, or very good or excellent. All you should do, I mean, at least this is what we do at our firm, is that we take a view on sectors, we take views on certain themes. So, for example, consumption as a theme, or banking as a theme, or technology as a theme, and we try and give those our set of money or our clients' money to those fund managers who are also of the same view. When you talk to fund managers, when you read their report, when you see their portfolio allocations, you will be able to figure out if it is matching your view or not. If it does, it means that you can go and invest into it. So best to know which is the best mutual fund, it is extremely impossible. You will know only after a year or two. But all I have always believed is that you, by giving your fund manager money to a good fund manager who's got great track record, you are reducing your risk of underperformance. So that's what we try and follow over and top of what we do. So Abhishek's question is on crypto. What is the question? So crypto, uh, at least for me, it looks like a speculative asset. If you really want to speculate without with a 50% chance of going right and going wrong, maybe you can try crypto. I have done it a little bit, but to be honest, will I go whole hog and ask my investors to invest 10-15% into it? No, not at all, because I don't understand it. It may turn out to be good, but it's purely speculative in my opinion. Yes, good question. How do we value Paytm? I have no idea because I'm not into stock analysis. We are more asset allocators. How do we value any businesses for that matter is, especially what I've understood is startups that have got great brand recall, startups that are always re-engineering them for the customer's need, startups that are really, really on top of their on top of the business, trying to allocate, modify, get more and more investments, not from PEs, from investors. I think those are the kind of startup that you should bet on. Money will definitely flow in, maybe whether it will flow in today or tomorrow, the profit will always happen. So it's more of a view that you need to take on how this particular startup will turn out in the next 5-6 years and invest into them. As a matter of fact, Paytm, or I mean, between Paytm, Zomato, and Swiggy, if I were to given a choice, I would have invested in Swiggy 10 years back or 5 years back itself. I really like what they do. But yeah, this is not an investment suggestion. Now, can you invest into it? In terms of current company, can you also talk about your portfolio or maybe investments? Yes, Naresh, so mine is very simple. I have invested in mutual funds. I've been doing it regularly for maybe 15 years now, right from my second firm. I've been investing regularly, trying to increase every time that I get my income up, reducing expenses and increasing my income. That's where I increase my savings. I keep investing into mutual funds. I have PMSs with very good fund managers. Those days, the minimum investment in PMS was 25 lakhs. So it was a lot more affordable. And I have stock portfolios. When I mean portfolio, actually, I have only one portfolio of 2 stocks. I am a very aggressive investor when it comes to stocks. I have a little bit on crypto. Real estate is where I live. I don't invest in real estate. I own real estate because I live there. And these are my primary assets. And my biggest asset is my own company, right? I mean, I hope one day somebody values that a few hundred crores. With market being at all-time high, should we invest into the market? Of course, yes. The only thing that you need to see is if you need the money in the next 2 years, don't touch the market. If you believe that you're in it for long term, you should just blindly invest into the market. Primarily because an all-time high, this is my research, 80% or 83% of the times an all-time high is followed by another all-time high. That is one. Second is all-time high is just a feeling. You never know whether this can end up becoming an all-time or a 52-week low, right? It is only time will say whether this is an all-time high for the next 3-4 years or it's an all-time bottom, or sorry, not all-time bottom, but 52-week low. So essentially what I'm saying is don't worry about prices, don't worry about too much about what is the valuation. Just make sure that you align your goals, long-term goals with equity investing and start investing. Trade like institution, you should not trade at all. Um, Trading is something which everybody should avoid. This whole presentation was about not trading. Trading is good if you want to have some adrenaline rush. It'll give you some immediate, let's say, gratification. Sometimes you make 2% in a day, sometimes you make 5% in a day. But net in the longer run, I am yet to find one guy or two guys who have actually made money out of trading, active trading. You may be lucky a couple of times, as they say in the initial days, you're lucky and stuff like that. But net, I have not seen anyone making large set of money from trading. So my suggestion or request to you is we are not experts in investing. So rather we give our hard-earned money to those experts. Let them manage our money. We are good at IT, we are good at FMCG, we are good at whatever the business that we are in. Let's start focusing on that and leave investing to the best guys on available to you, whether it is via mutual fund, whether it is via PMSs, whether it is via stock analysts and stuff like that. And if you don't have the time to do that, that is where we come into the picture. We help you do the right asset allocation. We help you to figure out what is the kind of the money that you should put into a certain asset, whether it is equity, debt, commodity, real estate. So that is where our planning comes in. So trading, definitely no. I have seen a lot more losses than any profits in trading. So anybody who asks me what should I trade on, I would say trade on nothing. So I would wait for a couple more minutes to see if there are any questions. By the way, I'm on. You can click on the Linktree button. You will see all the channels that I am, all the social media that I am in. Please click and follow me. It'll also boost me to give you more and more contents. I bring in YouTube videos, the same the topics I discuss in detail in my YouTube videos. I am very active on LinkedIn, and I'm also very active. I've started being active, a little more active on Twitter, and just opened a Twitter Insta account, which is called Money Mindset _Anand Kerati. See, the thing is, as I said, I mean, there's a sense, yes, for example, institutions do have leverages at their behest. They have the best of the technologies at their behest. They have the best of the brains at their behest. So they can all try and win the game. But as I said, right, as a retail investor or a trader, it is very difficult for us to get the kind of bandwidth that they have, and essentially, they are in for a very small money. And they put in a very small amount of money into trading as against us. So my suggestion is, it's a, when it comes to others' money, you act differently, and when it comes to your own money, you act differently. So trading for an institution is very different than trading for yourself, right? You may make large set of money initially, but net you will not make money in trading. That's my fair point. I mean, you can always think, you'll always hear in the next 2-3 years, because we are going to see a tremendous amount of bull market going forward, that I made money out of trading, मैंने ये लिया था, मैंने ये बेच दिया, मैंने 10% कमा लिया, 50% कमा लिया 6 महीने में. All that stuff is going to happen. So be very wary and careful of it. You need to understand that the guy who is doing it may not really be qualified enough to do it. So it's a chance and luck that is helping them do it. So try and avoid that. Be sane, be very safe with your investments. Invest in good quality companies or good quality funds, And I think that should do your job. At the end of the day, if your return expectation is that I'm a young investor and I want to double my money every 5 years, I think you don't need to struggle for that. You just need to give it to a good fund manager and they should do their job. Okay, inflation is a great topic. Incidentally, India is seeing the reverse. We are seeing WPI, the wholesale price index, going up while the retail inflation coming down at 4% or so. I think the commodity price increase cycle is almost done. Maybe for some time, high inflation may not really be the topic. You could see that with the stance that RBI has taken, it has become very accommodative, of course, thanks to the new strain of the virus also. It will lead to, I was honestly, when I spoke to the CIO, Chief Investment Officers of a lot of leading AMCs, asset management companies, they all told me that there will be a repo rate increase, which didn't really happen, which was a shocker to everybody. The repo rate increase will happen, but to be honest, the price of the bond is already reflecting the repo rate increase. So it may not really affect us very badly until unless the repo rate hike is like 50, 60 basis point, which I don't think will happen. So the repo rate hike is going to come maybe in the next 4 months or so, or 2 months or so. Till then, what I can definitely see is RBI's stance is pro growth, which is great for investors in equity. So yes, across the globe there is high inflation, and there must be some moderation because next year onwards, the supply chain, the logistics, and all is expected to be slightly more better than what happened right now. And then the base effect also comes in. So for all you know, it may not really be as scary as it may sound. So one more question if you have any, and else we can call it off. Okay. Right. So my only request to end with is, please train your mind to accept losses. When I mean losses, real or virtual losses, please accept or train your mind to see ups and downs in portfolios. You will see a lot of volatility. You will see your investment going up by 20% and then coming down by 5%. Don't worry about the 5% fall. Be happy about the 15% growth that you have seen. And if you could grow your 15% on a year-on-year basis, trust me, you don't need to worry about any goals. You just need to concentrate on increasing your savings rate and making sure that the portfolio that is created suits your requirement. Just custom design your portfolios, and please speak to good portfolio managers. Please try and talk to good investment managers. They should help you with this entire planning. Good luck with that, and thank you for coming in. Please join me next week also. Would love to see you again. Thank you again.